Greetings everyone and welcome to the Manifested e-learning platform. Today we are going to continue studying the subject auditing and assurance. In our today's lesson we introduce a new chapter, errors, frauds and irregularities. This chapter is organized into 11 subtopics, namely number 1, differences between error and frauds, number 2, types of errors, number 3, types of frauds, number 4, causes of frauds and fraud triangle, number 5, indicators of errors and frauds, number 6, detection and prevention of errors and frauds and deterrence, and the role of internal audit, number 7, materiality and implications of errors and frauds in the financial statements, number 8, impact of errors and frauds on the audit plan, number 9, reporting on error and frauds, number 10, external auditors and management responsibility on error and frauds, then lastly, auditors' professional skepticism. These are 11 sub-chapters. We are going to be studying each chapter at a time, beginning with the differences between error and frauds. Differences between error and frauds. But before we get into the differences between error and frauds, it's important for us, first of all, to understand the meaning of errors, what is the meaning of frauds, what is the meaning of irregularities. And candidates, in the world of finance and auditing, the terms errors, frauds, and irregularities are critical yet distinct concepts. They represent different types of misstatements or deviations from expected norms that can occur within an organization's financial records or operations. So the first term here is errors. What are errors? Now, errors are intentional mistakes in financial reporting. Unintentional. These are errors that are not intentional. They can arise from various sources, including miscalculations, misapplication of accounting principles, or even just simple oversight. And errors can be material, which means they can be significant enough to influence decisions, or they can be immaterial. Errors can be insignificant or they can be significant. So errors are unintentional mistakes. These are mistakes that are not deliberate, like when you make a typo, when you make a miscalculation. That is an example of an error. Then we have frauds. Fraud. Now, frauds are deliberate acts of deception, lying, okay, that is intended to gain an unfair or an illegal advantage. So fraud is intentional. Fraud is a deliberate act of deception intended to gain an unfair or illegal advantage. And frauds involve misappropriation of assets, which means just stealing from the company. Stealing from the company. Okay, you've seen people take away pens from the company to their homes. The people take stock from the stores to their homes. That is misappropriation of assets. That is stealing from the company. So fraud can be in form of misappropriation of assets, which is stealing, or just fraudulent financial reporting. For example, manipulation of financial records. Okay, where accountants may just manipulate financial records, increase expenses or increase revenues or reduce cash. That is fraud. And frauds are always intentional. Frauds, unlike errors, are always intentional. They are always intentional acts, and they often involve concealment. When people commit fraud, they then conceal or hide so that it is not known. All right? Because when you steal, you would not want people to know that you've stolen. So it involves an element of concealment. And later on, we'll be discussing the concept of fraud triangle. The causes of fraud will be studying in detail. So that's the meaning of fraud. Then there is this term irregularities. Irregularities. Now, irregularities are simply violations of laws, regulations, internal policies, rules, and so on. Violation. When a company violates laws or regulations, when an employee violates or breaks rules, then we say that is an irregularity. You understand? And while they are not always fraudulent, that can indicate potential issues like non-compliance, like unauthorized transactions, or even mismanagement. So irregularities can create an environment where fraud is likely to be perpetuated, where fraud is likely to occur. So that's why candidates is important for us before we get into the topic to understand the distinctions between errors, frauds, and irregularities, which is vital for maintaining the integrity of financial reporting and detecting potential risks. And therefore, candidates, auditors, accountants, as well as even the management, they all play a role in the prevention, in the detection, and also correcting the misstatements. So this topic, candidates will be delving deeper into the types of errors, the types of frauds, their causes. We'll be looking at their indicators and also the roles of different stakeholders in addressing them. So we'll also explore the concepts of materiality in subtopic number 7, materiality and implications of errors and frauds, and even the impact of errors and frauds on such as the misstatements, which can then influence the financial statements. And there's also something on the effect of errors and frauds on audit plans. In subtopic number 8, we'll study the impact of errors and frauds on the audit plan. So candidates, let's then discuss the differences between errors and frauds. Differences between error and frauds. Now, in discussing the differences between error and frauds, we're going to have a basis for distinction. We're going to have a column here for the basis. Then we have error. Then we have frauds. Basis for distinction. Now, first of all, before we get into the first basis, first of all, candidates, errors and frauds while both involve inaccuracies and while both they involve inaccuracies, they differ fundamentally in their nature, in their intent, in their implications, and so on. So we'll first highlight the first basis, which is nature of occurrence. One, nature of occurrence. What is the nature of occurrence of errors or error? Now, errors are, we said, unintentional. Errors are unintentional. In defining errors, we said errors are not intentional. Errors are unintentional mistakes. Errors are unintentional mistakes or omissions that occur during, say, data entry, during processing of transactions, or even reporting the transactions. And they can result from human error, they can result from system malfunctions, or even just lack of knowledge. So errors are unintentional. Errors, number one, are unintentional. Errors are unintentional. Now, on the other hand, frauds are deliberate acts of deception. Frauds are deliberate acts of deception. They are deliberate. When one commits fraud, it's an act of deception. Okay? It's not unintentional. People plan to defraud companies. Frauds are deliberate acts of deception. All right? You understand? That is intended to secure unfair or unlawful gain, like stealing the company's assets. That is fraud. One who steals from the company, the purpose is to gain unlawfully from the company, and they involve in intentional manipulation. They entail falsification or even alteration of records and documents. You understand? So error is unintentional, frauds are deliberate. The second basis for the distinction is on the basis of intent. We can distinguish errors from frauds on the basis of intent. On the basis of intent. So as for errors, there is no malicious intent. There is no malicious intent, because by their very nature, errors are unintentional. So there is no malicious intent there is no malicious intent. No malicious intent is involved in errors. No malicious intent is involved in errors. They happen due to carelessness, it can be due to oversight, it can be due to lack of understanding, and so on. But on the other hand, frauds are characterized by clear intent. Characterized by clear intent. They are characterized by clear intent to deceive. Frauds are characterized by clear intent to deceive, by clear intent to deceive, to mislead, to defraud. And the perpetrators knowingly commit the act in order to gain a benefit or to cause harm. So the two can be distinguished on the basis of intent. The third basis is detection and identification. Detection and identification. Detection and identification. Now, errors can often can be often be detected through regular reconciliations. It can be detected or identified through regular reconciliations. If there is an error in saying balances of cash or balances of bank balances, then there are errors that can be identified by just carrying out reconciliation. If it is errors in debtors or trade receivables, a reconciliation can be done and the error can be identified and detected. And that's the reason why reconciliations are done. We do reconciliation in order to identify or detect any errors. Errors can be detected through standard reconciliation processes, through reviews, through audits, reviews, and so on. So the detection and identification of errors and frauds are different. So if reconciliations are done, if audits are done, then errors can be detected, they can be identified. But when it comes to fraud, it's not easy to identify fraud. Frauds are harder to detect. These ones are harder to detect. And frauds are harder to detect because the ones who commit fraud, they conceal it. The frauds are designed, are deliberate, and those who commit fraud have clear intent to deceive. And that's why it is hard to detect or identify fraud. It is harder to detect fraud as compared to errors because they are designed to conceal the truth. And detection often requires thorough and detailed investigations. And detection requires thorough and detailed investigations. You may need specialists, you may need people who are qualified, you may need forensic audits in order to detect frauds, because those who commit frauds have the intent of hiding or concealing. You understand? So the detection and identification of errors and frauds is quite different. Okay? Detection often requires thorough and detailed investigations. It requires forensic accounting and sometimes whistleblower reports. So that's the third basis for the distinction between errors and frauds. The fourth basis is impact. The impact of error, the impact of frauds are also different. The impact of errors is usually limited to operational inefficiencies. Limited to operational inefficiencies. The impact of errors is limited to operational inefficiencies. It is limited to inaccurate, it's also limited to inaccurate financial reports or even regulatory non-compliance. And they can be generated, they can generally be corrected once identified. But on the other hand, the impact of fraud is more severe. The impact of fraud is more severe. Impact is more severe. The impact of fraud is more severe, potentially leading to significant financial losses. Leading to significant financial losses. The impact of frauds as compared to errors is more severe, leading to significant financial losses, leading to legal consequences, leading to reputational damage, leading to loss of stakeholder trust, and so on. So that is distinction based on impact. Now, the fifth basis for distinction between errors and frauds is response and rectification. Response and rectification. Response and rectification. How do you rectify errors? How do you rectify frauds? What is the response of management to errors? What is the response of management to frauds? Now, errors once identified can be corrected through adjustments. It can be corrected through restatements. It can be corrected through reprocessing of data, and so on. So errors can be corrected through adjustments. Adjustments can be corrected through reprocessing of data, and so on. To rectify an error, one needs to do a restatement, one needs to do an adjustment to the statements, or to the ledgers, or to the journals. Rectification can also be done through reprocessing of data so that you can have the right balances. But fraud on the other hand, may need legal action. Addressing fraud involves legal action. Because fraud is a criminal offense. It may need legal action to rectify fraudulent activities. Addressing fraud requires or involves legal action. It may require recovery of assets. That's why in a different lesson we studied the process of recovering assets. We also studied the regulatory framework for recovery of assets, and that is in response to fraudulent activities. So to rectify fraud, then one has to, it involves legal action, it involves recovery of assets, it involves things like implementation of stronger internal controls, and even prevention measures, which could include stricter audits. Do you understand? It may include also things like carrying out background checks, putting in place fraud detection measures, fraud detection systems, and so on. That is how the organization may respond to acts of fraud. But for the errors, adjustments are just required, because remember we say that the impact is limited to operational inefficiencies. But for fraud, the impact is more severe. It may lead to significant financial losses, and due to that, then the individuals involved in fraudulent activities may be taken to court. They may be need to recover assets. They may be need to make major changes in the internal control system of the company, and so on. Then lastly, we can distinguish errors from frauds on the basis of legal and ethical considerations. Legal and ethical considerations. On the basis of legal and ethical considerations. Now, while errors may result in regulatory scrutiny, they typically do not lead to severe legal consequences unless they reflect a pattern of negligence or a systemic failure or systemic issues. You understand? Errors may result in regulatory scrutiny, but they typically do not lead to severe legal consequences. They do not lead to severe legal consequences. Errors do not lead to severe legal consequences. Whereas fraudulent activities can result in criminal charges. Can result in criminal charges. Those who are involved in fraud can be prosecuted in a court of law, can lead to criminal charges, can lead to lawsuits, can lead to severe penalties. Lawsuits, it can lead to severe penalties. They can lead to lawsuits, they can lead to severe penalties, they can lead to criminal charges. You understand? You understand? And that can involve individuals who are being prosecuted or even organizations. So that is the distinction, the difference between errors and frauds. Errors and frauds. We've said the two can be distinguished on the basis of nature of occurrence, intent, detection and identification, impact, response and rectification, and legal and ethical considerations. We've given 6 distinctions: 1, 2, 3, 4, 5, 6. 1, 2, 3, 4, 5, 6. And that is the end of the lesson. I'm going to give you an assignment. 1. What is the fundamental difference between errors and frauds in financial reporting? 2. Explain how the intent behind an action determines whether it's classified as an error or fraud. 3. Provide 2 examples each of errors and frauds that could occur in the accounts receivable process. 4. How might the materiality of a misstatement influence its classification as an error or fraud? 5. What steps should an auditor take if they suspect a misstatement might be fraudulent rather than an error? Thank you. We'll meet in our next session where we'll study types of errors. Bye.